Most traders ignore the higher time frame because they think trading the lower time frame will give them a quick move. But that's the problem. Lower time frame moves follow what the higher time frame has already indicated, because price is fractal. If it's moving to upside on the higher time frame, the lower time frame will move the same way. Let me show you the exact checklist I use to decide whether to buy, sell, or stay out. So let's get straight into it. Before we start, let's first be clear about what daily bias actually means, because this is one of those terms that a lot of retail traders love to throw around. But if you actually ask them what it means, they usually cannot explain it properly. You will hear traders say things like, "My daily bias is bullish," or "the bias is bearish." But when you ask them why, or what exactly defines that bias, the answer is often vague. It is similar to how people talk about trends. Everyone repeats the term, but very few actually understand the reasoning behind it. So here is the real definition. Daily bias is simply where you believe price is most likely to move within the next 24 hours and why. The key phrase here is most likely, not guaranteed, not certain, just the direction that currently has the higher probability based on the information available. And this is where many amateur traders get it wrong. A lot of beginners approach trading like they are trying to predict the future. They think the goal is to be 100% certain about where price will go next. They treat trading like fortune telling. But that is not how professional trading works. Professional traders accept uncertainty. They know that the market can move in any direction at any time. Instead of trying to predict with certainty, they focus on managing risk and consistently executing a plan where the odds are in their favor. Trading is not about being right all the time. It is about placing yourself in situations where the probability and the risk to reward are favorable. That is exactly what daily bias helps you do. It gives you a framework to filter the market. Instead of looking for trades everywhere, you focus on setups that align with the direction that currently makes the most sense. Again, not guaranteed outcomes, just higher probability opportunities. And it is also important to understand something else. Your bias is still your interpretation of the market. It is your perception based on the information you are analyzing. It is not the market itself, and it is not objective reality. That means you can still be wrong no matter how many confirmations or confluences you believe you have. But when you actually have a clear daily bias, several things become much easier. You will know where it makes sense to look for buys and where it makes sense to look for sells. You will have an idea of where the market is likely drawing next in terms of liquidity. You will know when the conditions align with your plan and when it is time to execute. Just as importantly, you will know when to stay out of the market. And that is something many traders struggle with. One more thing that is very important to understand: bias is not a prediction. Bias is a plan with invalidation. In other words, you are saying, "This is what I currently think the market is likely to do, and this is the condition that would prove me wrong." If that invalidation point gets violated, you do not argue with the market, you adjust. Because if you do not have a clear invalidation point, you do not actually have a bias. What you have is hope, and hope is not a trading strategy. Hope is simply outsourcing responsibility to luck. At that point, you are no longer following a structured plan. You are just hoping that price does what you want it to do. And the market does not care about what we want. It only responds to liquidity, order flow, and structure. So the goal here is not to be certain. The goal is to build a framework that gives you direction, probability, and clear invalidation so you can trade with discipline instead of emotion. So now that you understand why daily bias is so important, let me walk you through the 5-step checklist that I personally use to build my daily bias. The beauty of this process is that it is simple, repeatable, and structured. Anyone can apply it as long as they follow the steps consistently. The first step is identifying the higher time frame trend. The goal here is to stop trading in the middle of nowhere. A lot of traders open a chart and start reacting to every small move they see. That approach leads to random trades and inconsistent results. Instead, what we want to do is limit our focus by defining the range that actually matters. For example, when I look at a chart like this on the 4-hour time frame, the first thing I notice is that price is moving upward. We can see that clearly because price is forming higher highs and higher lows. Once I recognize that structure, the next thing I want to identify is the break of structure that confirms the trend. That break of structure helps me understand where the trend is currently developing and also allows me to define the swing range that I want to focus on. The swing low that led to the break of structure becomes the lowest point of the range, and the highest point before price begins to pull back becomes the swing high. So by doing this, I have immediately defined the area of the chart that matters for my analysis. Now, instead of paying attention to all the random price action that happened far in the past, I can focus on what price is doing within the current range. That range is what will guide my decisions moving forward. Before we even talk about liquidity, supply and demand, or any other concept, we first need to answer a simple question. Where is price located within the higher time frame range? If you do not know the answer to that question, then you are essentially making trading decisions without context. So the process is very simple. Identify the most recent swing low and swing high on the higher time frame. That defines your range. Once the higher time frame range is defined, the next step is to determine whether price is trading in premium, discount, or around the equilibrium of that range. To do this, we use a simple Fibonacci retracement tool. You place the Fibonacci from the swing low up to the swing high. This gives you a visual representation of the range and divides it into premium and discount zones. The area above the 50% level represents premium pricing. This means price is relatively expensive compared to the rest of the range. The area below the 50% level represents discount pricing. This means price is relatively cheap within the range. So when price is trading in the premium zone, I am not interested in buying. Instead, I am looking for short opportunities because the market is trading at a relatively expensive level. When price is trading in the discount zone, that is where I begin looking for long opportunities because price is relatively cheap within the range. And then there is the middle of the range, around the equilibrium. This is where many traders lose money. When price is stuck around the middle, the market is often indecisive. Direction is less clear, and price can easily move in either direction. That is where you see a lot of choppy movement and false signals. So my rule is very straightforward. If price is above the equilibrium in premium territory, I focus on short opportunities. If price is below the equilibrium in discount territory, I focus on long opportunities. If price is stuck in the middle of the range, I either reduce risk significantly or simply stay out of the market and wait for price to reach an extreme. This one step alone can clean up a lot of confusion for traders. Instead of guessing direction randomly, you are trading based on location within the range. By doing this, you are not trying to predict the market blindly. You are positioning yourself where the probability is more favorable. For example, if I look at the chart and see that price is currently in premium territory, my bias becomes bearish within the range. I will look for short opportunities until price moves down into the discount area. Once price reaches the discount zone, I can shift my bias and begin looking for long opportunities as price potentially creates a new higher low and continues the broader bullish trend. And that is how the first step of the daily bias framework works. It starts with understanding the higher time frame structure and then using premium and discount to determine where the best opportunities are likely to appear. Now, step 2 is marking liquidity, which basically means identifying where the stop orders are sitting in the market. Once you have figured out whether price is trading in premium or discount, the next question you should ask yourself is simple. Where is the obvious liquidity? Price does not move randomly. Price moves toward orders, and those orders are what we call liquidity pools. Large participants need liquidity in order to move the market in the direction they want. Without that liquidity, they cannot efficiently enter or exit positions. I have already made several videos explaining different types of liquidity, so I'm not going to go through every possible liquidity pool here. For the purpose of building your daily bias, you really only need to focus on 2 main liquidity pools, The first one is the prior day high and the prior day low. To mark this, you simply go to the daily time frame and look at the previous day's candlestick. The highest point of that candle is the prior day high and the lowest point is the prior day low. These represent the extreme points where price traded during the previous 24 hours. Once you identify those levels, you simply draw horizontal lines across the chart. What you are doing here is marking areas where a large number of orders are likely sitting. Why are these levels important? Because retail traders and breakout traders often place their stop losses around these areas. For example, traders who went short may place their stop losses above the previous day high. Traders who went long may place their stop losses below the previous day low. So when price reaches those levels, there is usually a cluster of stop orders waiting there. That creates liquidity. If you look at how price behaves around these levels, you will often notice that price will move up to sweep the prior day high or down to sweep the prior day low before reversing or continuing. For example, if we go down to the 4-hour chart, you can clearly see this behavior. Price moves up and takes the prior day high, collects the liquidity above it, and then starts reversing. Similarly, price may drop below the prior day low, sweep that liquidity, and then reverse upward. This is why marking the prior day high and prior day low is such an important part of building your daily bias. The second type of liquidity pool you should focus on is equal highs and equal lows. When you see 2 or 3 highs forming at the same level, many traders call that resistance. But in reality, what you are seeing is a pool of stop losses sitting above those highs. The same idea applies to equal lows. Multiple lows forming at the same level create a pool of stop losses below them. For example, imagine price moves down, then up, then down again to the same level, and then moves up once more. Now you have equal lows. That means there is a cluster of stop losses resting below those lows. Very often, price will come down and sweep that liquidity before moving in the opposite direction. The same logic applies to equal highs. If price forms multiple highs at the same level, you can expect liquidity to build above them. Price may later move up, sweep those highs, collect the liquidity, and then move lower. So when you are marking liquidity, you should ask yourself a very important question. Which side has the most obvious liquidity? For example, imagine price is currently trading in premium territory. Above the current price, you might see a clean prior day high and maybe a set of equal highs. That means there is a clear pool of liquidity sitting above the market. If price wants to move lower afterward, it may first move up to sweep that liquidity. Once those stop orders are triggered, that liquidity can provide the fuel for a larger move to the downside. The same logic works in reverse. If price is trading in discount territory, and below the market you see equal lows and the prior day low, then there is obvious liquidity sitting below. Price may drop down, sweep those lows, tap into discount pricing, and then reverse upward. However, it is important to understand something here. A liquidity sweep does not automatically mean price will reverse immediately. Liquidity simply means a target. It is an area where price is likely to move toward. But once price reaches that liquidity, the market may either reverse or continue in the same direction depending on supply and demand conditions. For example, price might sweep the equal lows and still continue lower if sellers are strong enough to keep pushing the market down. But regardless of what happens afterward, identifying liquidity helps you understand where price is likely to gravitate toward in the short term. So step 2 is very straightforward. Mark the prior day high and prior day low. Then identify any obvious equal highs or equal lows. Once you have those levels marked, ask yourself which side has the most obvious liquidity. That will give you a strong clue about where price is most likely to move first within the next few hours. Now, step 3 is the part that most traders completely skip, and that is exactly why their bias keeps flipping every 15 minutes. They go from bullish to bullish again because they do not actually understand the story of the market. Step 3 is building the narrative. In other words, you need to understand the objective of price. At any given moment, price is only doing one of two things. It is either continuing the existing trend or it is pulling back before continuing that trend. So the first thing you want to determine is whether the market is currently in a continuation phase or a pullback phase. For example, imagine price pushes up strongly. That is continuation. Then price starts pulling back. That is a pullback phase. After the pullback finishes, the market usually continues in the direction of the main trend again. Markets constantly move in this rhythm, from imbalance to balance, from balance back to imbalance. That flow is the natural heartbeat of price action. Now, within this framework, there are two types of movements you need to understand. The first one is pro-higher time frame trend. This means the lower time frame is moving in the same direction as the higher time frame trend. If the daily chart is bullish and the lower time frames are also pushing upward, then the market is aligned. In that situation, you are trading continuation in the direction of the main trend. The second type of movement is counter-higher time frame trend. This happens when the lower time frame moves against the higher time frame trend. If the higher time frame is bullish but the lower time frame starts moving downward, that move is simply a pullback. It is the market retracing before potentially continuing upward again. So the basic rule is simple. If the lower time frame is moving against the higher time frame trend, you are most likely looking at a pullback phase. If the lower time frame is moving in the same direction as the higher time frame trend, then you are most likely looking at a continuation phase. Now here is an important warning, especially for beginners. You should avoid trading counter higher time frame trend and counter lower time frame trend at the same time. What that means is this. If the higher time frame trend is bullish, but the lower time frame is currently bearish because the market is pulling back, you should not try to buy immediately. Many traders try to catch the exact bottom during a pullback, and that usually results in getting stopped out repeatedly. If the lower time frame is clearly bearish during a pullback, the smarter approach is to trade with the internal order flow. In other words, you follow the direction price is currently moving until conditions change. If price is moving downward during a pullback, then you continue selling until price reaches a deeper discount level where a reversal becomes more likely. The key principle here is simple. Trade what the market is doing right now, not what you hope the market will do. If price is currently moving down, you sell. If price is currently moving up, you buy. Hoping that price will suddenly reverse without confirmation is just guessing. Once price reaches deeper into discount territory or into a strong demand zone, the probability of a reversal increases. That is when you start looking for evidence that the internal structure is shifting. Now remember, this video is about setting daily bias, not about detailed entry techniques. Daily bias tells you which direction to focus on and where price is likely to move next. Your entry model determines exactly when and how you enter the trade. A simple confirmation rule is this. If your bias is bullish, you should only look for buys after a liquidity sweep and a shift in market structure on the lower time frame. For example, if price is currently making lower highs and lower lows, the market is still bearish internally. In that case, you wait until price breaks the last lower high. That break confirms that the internal structure has shifted from bearish to bullish. Once that shift happens after a liquidity sweep, you have confirmation to start looking for long opportunities. If your bias is bearish, the logic is simply reversed. You wait for price to sweep liquidity, then you wait for price to break the last higher low. That break confirms a bearish shift in structure, and now you can begin looking for short opportunities. Now this brings us to step 4, which is defining your take-profit target. This is another place where many traders make mistakes. They mark 10 different targets and then panic as price moves between them. For daily bias, you only need one logical target. Bias is not about every possible place price could go. It is about identifying the most likely destination. So you simply ask yourself, where is the next logical magnet for price? There are 3 common magnets I focus on. The first is the prior day high or prior day low. Since these levels contain liquidity, they are often natural targets for price. The second is the opposing zone. If you are selling from a supply area, your target might be the next demand zone. If you are buying from a demand area, your target could be the next supply zone. The third possible target is an imbalance or fair value gap that has not yet been filled. Price often gravitates back toward inefficiencies in the market. But the key point is to keep it simple. One direction, one target. For example, if I enter a short from a supply zone in premium territory, my target might be the next demand zone or the prior day low. If I enter a long from a demand zone in discount territory, my target might be the next supply zone or the next swing high. When you define one clear target and align it with your bias, you are no longer guessing. You now have a structured plan for how the trade should unfold. The last step, step 5, is defining invalidation. This is the step that separates traders who actually have a plan from traders who are just hoping the market goes their way. A real bias is not simply saying, I think price is going to go up. A real bias also includes a clear line in the sand that tells you when you are wrong. In other words, you must define the condition that invalidates your idea. Here is the mindset I want you to adopt. Good traders think about the next move. Great traders think several moves ahead and consider the consequences of their decisions before they even take a trade. They are constantly asking themselves what could go wrong. They mentally play through different scenarios before confirming their bias or entering a position. Your job is simple. Complete this sentence. My bias is wrong if this happens. That condition becomes your invalidation. For example, if my bias is bullish, then my bias becomes invalid if price breaks and holds below a key level. Not just a quick wick below it, but a real break followed by acceptance below that level. On the other hand, if my bias is bearish, then my bias becomes invalid if price breaks above and holds above a key level. Again, this must be a genuine break with acceptance, not just a temporary spike. The important part is understanding the difference between a wick and real acceptance. A wick can simply be a liquidity sweep. But if price breaks a level and begins holding above or below it, that is a sign that the market structure may have shifted. And this leads to one of the most important discipline rules in trading. If my bias is invalidated, I reset my bias. That means if price breaks the level that invalidates my idea, I do not argue with the market. I do not revenge trade. I do not double down trying to recover a loss. Instead, I accept that my original read was wrong, and I reassess what the market is doing. I step back, reevaluate the structure, and build a new narrative based on the updated information. If you do not have a rule that clearly invalidates your bias, then you do not actually have a trading plan. What you have is hope. And hope is not a strategy. Hope is simply outsourcing responsibility to luck, and luck is not something you can rely on in trading. So to recap, these are the 5 steps to building a daily bias. First, identify the higher time frame trend and define the range. Second, mark the obvious liquidity such as prior day highs, prior day lows, and equal highs or lows. Third, build the narrative by understanding whether price is in continuation or pullback. Fourth, define one logical target that price is most likely to move toward. And fifth, clearly define the level that invalidates your bias. Once you can consistently go through these 5 steps, you will have a structured way to approach the market every single day instead of reacting emotionally to every movement on the chart. All right, so that wraps up how I personally build my daily bias using this 5-step framework. Remember, the goal of daily bias is not to predict the market with certainty. The goal is to create a structured plan for where price is most likely to move next and how you will react if the market proves you wrong. If you consistently mark the higher time frame range, identify premium and discount, locate the obvious liquidity, understand whether price is in continuation or pullback, define a clear target, and set a proper invalidation level, you will always approach the market with a plan instead of emotion. Now, the most important thing is practice. Go back to your charts, replay previous days, and walk through these 5 steps until it becomes second nature. If this video helped you, make sure you like the video, subscribe to the channel, and share it with someone who wants to improve their trading. And if you want to connect with me, join my Telegram and Discord. Links are in the description. I will see you in the next one.